Welcome to today's Breaking Down Barrier Income podcast. Breaking Down Barrier Income is a monthly series featuring Simplify's Barrier Income ETF, ticker symbol SBAR. SBAR is just over 1 year old, launched mid-April of 2025. Today we're reviewing performance and positioning through the end of April of 2026. We believe at Simplify, we're transitioning the traditional structural experience by providing more of a outcome-based solution, an ETF wrapper. My name is Jeff Schwarty, Chief Equity Strategist at Simplify. Today, I'm very excited to have Paisley Nardini, Head of Multi-Asset Solutions here at Simplify, join us today to give her perspective on how SBAR has been used in model portfolios or client-oriented solutions, which may be more income-oriented. So, Paisley, welcome.
Yeah, thanks for having me.
Great to have you with us today. But before we get to the hard questions for Paisley, let's review the positioning and performance of SBAR through the end of April 2026. As we've all experienced the little bit of drama around equity drawdowns from basically the end of February through the end of March, we'll show throughout the presentation how SBAR performs. So, as a reminder, Simplify has three barrier income oriented strategies. SBAR, which is the focus today, every single barrier option has a 30% barrier level, which means if you close below the 30% level at the end of the contract, you fully participate in that drawdown. XV is a cousin of SBAR. We're targeting a yield of 15%. And then in November, we launched XXV, which targets a 25% income level, distribution level. And we're using individual stocks to create that outcome. So, and then on that right-hand side, we've also highlighted at times all three strategies currently do have a bit of a protection in the form of long put options to mitigate some of the volatility that we're seeing lately. So nothing's really changed with the product features, very consistent in the implementation of these strategies. The distribution rate for SBAR at the end of March was 12.25. The SECL was 3.51. So nice double digit, low double digit distribution rate for investors seeking income. As far as the performance is concerned, this is a since inception 14.6% total return for SBAR. We're comparing it to the Bloomberg US Ag Index. So a nice 14.6% return with a realized vol of 10.5%. So doing very, very well against a broad-based basket of indices. Now, if you notice on the right-hand side, and Paisley, you might have a few comments here as well, but we did see a pretty significant sell-off in the market. I think NASDAQ at its low point was down almost 9%. And as a reminder, SBAR uses S&P, NASDAQ, and Russell 2000 as the underlying reference indices. So a little bit of a sell-off driven by the Iran war, and then a pretty significant snapback. I think that's surprising a lot of folks with this continued expectation of resolution of that conflict in the Middle East. Paisley, any comments about the markets in that particular
Yeah,
period?
I think maybe we'll dive into this in a little bit more detail when we talk about like where to source this from and how to think about this in a broader portfolio context. But I think it's important to show the investor experience here as you have, because there is a mark to market risk, right? And I'm sure you'll talk about that, Jeff, is just thinking about like what does it mean from an investor experience perspective, even though you have this 30% barrier on SBAR. That doesn't mean that you're going to have like, a flat, cash like linear line from a performance perspective. You are going to experience some of this. And like I always like to say, there's no such thing as free lunch. And so when you look at that attractive total return, it is not without bumps along the way,
Mhm.
which ultimately just comes down to, as an investor, if you're replacing your, cash or T-bill short duration fixed income allocation with something like SBAR, you'll just need to consider that from like a liquidity perspective. If you need to draw on cash, if let's say, March 25th of this year, your clients needed cash, SBAR might not be the best daily liquidity tool, even though it is daily liquid. But I do think it's important to show this. And I think this is a good kind of snapshot of behavior relative to, say, core bonds that we're all very familiar with.
Yeah, good point. I think the mark to market is a really important feature because as we talk about, the distribution rate and the risk mitigation features, those are kind of a single contract point in time, assuming beginning and end period. But as you mentioned, it can ebb and flow throughout the life cycle of each of the barrier options. So let's go a little bit deeper. So as a reminder, the use case for SBAR is those seeking a high distribution rate. So 12.25 is the distribution rate at the end of March. It can be thought of as an alternative to equities with a 30% barrier that exist in the event that we do break the barrier, you fully participate. If you do not break the barrier at maturity date, you do not participate in the drawdown, which is very appealing to me. And then you got the alternatives to bonds from a credit duration perspective. This is really the heart of why we wanted Paisley to join us today is to give, a use case and how she's thinking about this in the portfolio. We'll come to that in a second. As a reminder, no lockups, continuous liquidity. We take care of all the rolling and monitoring all the positions, lower fees than if you were to buy a direct structure note in itself. So the callability and the worst of features, as a reminder, the callability, if you've had a period of time where equity reference indices have all appreciated from the inception of the contract, it gets called. Luckily, in the month of April, about 40% of the portfolio has been called, which is really exciting as the market's rebounded. A lot of those positions we put on did get called, so we were able to stack premium option income. And then, as I mentioned before, with the worst of when NASDAQ was down about 9%, SBAR was down maybe 4.5%, just because you look at the worst performing indices. The long put option did provide some protection during that drawdown earlier this year. And this is probably my favorite slide. We spend a lot of time. We put this on our website every single week. This is highlighting the positions at the end of April. So 41 auto call positions in the portfolio. If you look at the x-axis, you see the notional weighted position. Not in there's I think the largest one is just over 6%. So very diversified in the maturities of the contracts. About 33.3% is the weighted notional distance to barrier. At the market low, that got down to around 23%. So, drawdowns do happen, and you just have to be aware of that. What's interesting here, the end of April, 96% of the portfolio was eligible to be called, and we've realized about half of that already in the month of second half of April into here already in May. About 300 days to maturity and I've got the yields there as well. We still have a long put option in the portfolio, about a 2-month expiration to, again, provide a little bit more cushion if we continue to have drawdowns in the equity markets. But again, very diversified portfolio, large distance to barriers. So it's actually very fun to see it work as designed. And I think that's what gives confidence to asset allocators that use this for income-oriented solutions. Not much to say on the rate front. I think it's anyone's guess as to what's happening to rates. I think we definitely had 3 rate cuts last year, maybe rate increase this year. What's your base case scenario here, Paisley, on rates?
Yeah, well, we are recording this on the morning of May 12th, which is the release of the CPI number this morning. And as a result, inflation numbers came in a little bit hotter than expected, which resulted in rates backing up a little bit.
Yeah.
I think at least my perspective, and I think what markets are pricing in is it's kind of an asymmetric trade at this point. I think rates have really priced in higher for longer inflationary concerns. And so as we look at some of the technical levels of rates, this could be the upper end of the band. In other words, very simplistically stating, like maybe it's an attractive time to put on duration. And I know that sounds very contrary to kind of common market belief, but back to your specific question, Jeff, is markets are not pricing in any rate cuts. They're actually pricing in potential for a rate hike in 2027. I think the Bank of Japan actually just came out yesterday as well and is throwing around the potential for potentially hiking rates. I see it as oil kind of energy trade being transitory in nature. And so I think as soon as you price that out of your inflation, you're starting to move back in the right direction, inflation moving lower. And then I think markets might have to reprice in potential rate cuts if we get through kind of this tension in the Middle East. So from a rate perspective, I think it's probably range bound and kind of sticky for the next couple of months. But like I said, I think markets are kind of on one side of the trade, which presents an opportunity to take the other side.
Yeah, the reason we bring this up is because the distribution rate for SBAR is driven by two things, the T-bill income as well as the bearer option income. So keep a close monitor on this. Probably the major driver of the premium income for the option contracts is just realized volatility and implied volatility. At the left-hand side of this chart is upon launch of SBAR in April 2025, right after the tariff tantrum, and then get little bouts of volatility in November, and then a lot of volatility in March given the Iran conflict. So it's good to see the realized vols are coming down a little bit, but this has been a really attractive opportunity to roll some of these contracts.
I was going to actually ask that, Jeff. So I'm glad that we have this visual here because, to your point, we could not have timed the launch of SBAR better in hindsight because, in like to your point, on the far left of this chart, that spike in volatility results in us being able to sell these, collect a very attractive premium when we're selling
Yep.
these barrier put options. So just thinking about what's transpired over the last like 2 months, and the spike in vol that we saw kind of heading into the end of the first quarter, is that then present us with a really attractive opportunity of return potential over the next couple months because of this spike in vol?
Yeah, let me give you an example, Paisley. A typical barrier option contract, we might get 3.5%. Maybe the average outside of, say, June to February, we would have got about 3.5%. During this March run-up of volatility, we got a contract as high as 4.8%. So that's the opportunity that vol creates is higher option premium income, which again, our investors enjoy in the form of that increased distribution rate. So equities going up, which is great for auto call features of SBAR. Market volatility is also great from a premium option income perspective. And then correlations, I like to look at this as correlations become tighter, meaning they get closer to the top, the option premium actually goes down because things are all moving together. If you get dispersion in correlation, that actually creates better opportunity for option premium because you have the potential of one of them breaking the barrier, one of those three equity indices. So we're using S&P, NASDAQ, and Russell 2000. So I'm going to conclude the slides right now, and then Paisley, it's time for a couple questions. Are you
Oh,
ready?
let's go. Yeah, yeah. Feels like a game show.
For sure. You have to. I'm going to ask the question, and you're going to, ask for points afterwards.
And then I
Okay,
can phone a
so.
friend.
So, as an asset allocator, how do you think about, the feature of SBAR providing that low double-digit yield with this risk mitigation of 30%? How do you think of a traditional 60/40 portfolio? How do you think it fits into that mix?
I would backtrack to what we've been experiencing over the last, say, 4 years. So going back to 2022, when we saw stock bond correlations move from negative to positive territory, that's had massive ramifications for anyone in a role of an asset allocator, right? Because bonds have not been the ballast, bonds are not providing that cushion when we need it. 2022 is a great example. The first quarter of 2026 was another great example of that.
Mhm.
So, what does that mean? Investors are starting to really understand and evaluate and appreciate the role of diversified sources of risk and return in a portfolio. So, what hasn't changed though since 2022 is the need for income in portfolios. And so, because of the innovation, and SBAR was the first auto call ETF brought to market, like you mentioned, a little over a year ago, the ability to still hit those income targets that you need for your clients that are perhaps in the retirement phase or whatever their lifestyle is. The level of core bonds, I mean, you're maybe getting 4% from like a yield perspective in core bonds,
Yeah.
especially after inflation. That's not very exciting, and it's really not moving the needle or supporting your client's lifestyle needs. So the ability to still tap into something that's providing attractive levels of income in this environment that are also diversified. And we talked about kind of very briefly thinking about how to allocate to this within a broader portfolio. And we saw, and I'm glad that you shared some of the return paths that were experienced this year with some of the volatility. This is going to have features of both equity and both fixed income in the sense that we're getting income, but we also have some equity beta within this. And so I think from a funding perspective, there's really no wrong way to think about this because every individual has unique needs and different risk tolerances. The way that we think about it here at Simplify within our model portfolios, SBAR is becoming increasingly prominent part of many of our income focused models because of all the features you already mentioned, the consistency, the ability to take advantage of market dislocations, the uncorrelated source of return relative to both traditional assets like stocks and bonds leads us to really put this as kind of a core tenant within any income producing portfolio. So
Mhm.
again, if you think about core bonds, investment grade aggregate type bond exposure, low single digits from a kind of distribution perspective, all of a sudden now you can get something closer to 12%. And then you can start to pair things around that, other diversified sources, whether it be other derivative based income strategies, some higher yielding traditional sources of fixed income. And so, as we think about kind of the broader portfolio construction decision, this really deserves a place within any portfolio that has an income need. And then I would say the other really important feature, which kind of goes back to a macro and kind of more sentiment in the market, is that this anti-bond trade has really picked up steam in the last few years. I know we
Mhm.
just made a comment of, is that trade overblown at this point? We'll set that conversation aside for this next point. But if you are one of those advisors that is still under the belief that we are in a higher for longer regime, that inflation is absolutely sticky, it's not transitory, and so therefore you do not want to hold interest rate risk in your portfolio, because we know that doesn't do well in inflationary environments, this becomes a logical replacement to core bonds, because you're reducing your interest rate risk because there's a lack of duration within this, and you're
Mhm.
still maintaining and actually probably improving your income potential in a portfolio.
Yeah, I think what I love about SBAR and XV and XXV is that it's kind of a unique source of income that's not available traditionally in a fixed income portfolio, right? So these are a structured note or structured note. Structured notes have been around for a long time. It's contractual. It's pretty consistent. You do get the auto call feature, which I think is really, really favorable, especially in a rising equity market where SBAR's had a significant portion of the portfolio called, allows us to premium stack. And I just think they're a nice way to, as you mentioned, meet sort of income needs for investors. And that the auto stack actually offsets some of the limitations of covered call selling strategies that give up upside by providing income. If you have auto calls throughout the cycle of the portfolio, you do get, some compounding and upside potential. So very, very cool strategy. So when you think about like the betas or the correlations, and it's not going to be negatively correlated to equities and bonds because the income is going to be an option premium income that is probably unique for a lot of investors' portfolios, but the performance is really going to be driven by equities, especially the worst of the three underlying reference indices. So, what do you think the correlations would look like historically?
Yeah, so typically I would say, and this is just looking at the since inception period, for SBAR relative to say the S&P 500, like a zero point 0.6, zero point 0.7 type correlation. And I think if thinking about other ways to incorporate diversification in the portfolio, lower beta versions of equity, hedged equity is a typical solution that might have like a zero point 0.6 type beta. This is going to be very different in the sense that you're going to have high levels of income. But I do also think the feature of that barrier is really attractive, because we've seen really just massive amount of interest around solutions that have downside protection and more of that structure within them, so you know exactly what you're getting from a downside protection perspective. So not only are you getting the higher levels of income, you're also getting that downside protection as well. And ultimately, this goes back to the bigger picture. There's so much uncertainty in markets right now. Clients love the idea of knowing exactly what they're going to get and when they're going to get it. So I think that that's another reason this is really resonated in advisor portfolios. And then back to your question around correlation, relative to say the core bond market, SBAR has had about a zero point 0.2 correlation
Okay.
since we launched. So again, you're not getting that interest rate risk, but it is a lower volatility version of just pure equity risk. So there is some correlation to both of these. And again, that's why it goes back to, how do you source this? How do you fund this? We see a lot of advisors typically just use their core fixed income holdings. They sell that and buy an SBAR. But because of that correlation profile I mentioned to equities, to balance overall risk in the portfolio, sometimes we'll see clients sell a bit of their equity exposure as well.
Yep, yep. Well, I think it's a great tool for investors to incorporate for the outcome-oriented needs. I think the opportunity is there for investors to capitalize on this kind of a newer venture in auto call ETFs. There are other competitors in the marketplace. How they get their income can vary. Typically, they're going to go longer maturities than us. We're 1 year or less, and they're may or may not be hedging. So I would encourage you to do your research, but we think SBAR, XV, XXV provide a really attractive opportunity. Paisley, thank you so much for your time
Thanks for having
and
me.
joining us today. And I'll conclude with just a comment that we're here for you as clients. If you have any questions, feel free to reach out to us. We enjoyed doing this monthly series featuring the performance and the outcomes that we're generating. And if you have any questions, please feel free to reach out to us. Thank you.